Welcome to the Deep Dive. You're here because you've got your sights set on mastering the SAFE exam, aiming for that perfect 100.
Mm-hmm.
It's a challenging test, definitely. A
Yeah,
lot of complex information to navigate, and that's precisely why we're here today, to give you that critical edge.
exactly. Our mission today really is to cut through the density of the key financial regulations and consumer protections source material.
Yeah, there's a lot there.
There is. We're going to extract the absolute core insights, those crucial nuggets, and especially those tricky details that examiners, well, they just love to focus on.
Right.
Our goal is to make sure you don't just know what these regulations say, but you truly understand why they matter. That sets you up for that flawless score.
This deep dive is all about precision then. We'll be zeroing in on the rules, the definitions, their practical applications, all with a laser focus on what you need to recall for test day.
Think of it as your roadmap.
Yeah, think of this as your personalized roadmap to mastery, designed to give you those aha moments that make everything just click.
Let's do it.
Okay, let's begin our deep dive into the regulatory landscape. We'll start with two foundational pieces of legislation: the Fair Credit Reporting Act, or FCRA, and its vital amendment, ECTO-A.
Good starting point. These acts really form the bedrock for how our personal financial info, especially credit data, is handled. Fairness and accuracy, that's the key.
So FCRA first.
Right, FCRA. It became law back in 1970. Its core aim, and the source is very clear on this, is to ensure the accuracy, fairness, and privacy of consumers' personal information assembled and used by consumer reporting agencies, CRAs.
Okay, accuracy, fairness, privacy. Sounds straightforward, but powerful.
It is. This isn't just bureaucratic language. It's about protecting consumers, preventing misrepresentation that could seriously mess up someone's financial life.
Makes sense.
And an interesting point, the source notes, if a law doesn't specifically spell out damages, sometimes a community might use another law, like ECOA, the Equal Credit Opportunity Act, to find some recourse.
Okay, good to know. So if it's all about ensuring fairness and privacy, who's the regulatory muscle here? Who's keeping an eye on FCRA compliance?
Primarily, it's the Consumer Financial Protection Bureau, the CFPB. They hold the general authority to enforce FCRA.
Right, the CFPB. We hear a lot about them.
You will. But the Federal Trade Commission, the FTC, they actually retain some rulemaking and enforcement power, too. It's not solely the CFPB.
Uh-huh.
And for your exam, a really key detail to remember is the specific implementing regulation for FCRA. It's known as Regulation V.
Regulation V, got it.
Yeah, and you'll also find that Regulation V includes Appendix M, which is helpful because it provides model forms for the required FCRA notices and disclosure.
All forms, okay. So what kind of transactions does FCRA cover? Is it just mortgages?
Oh no, it casts a very wide net. The source says it applies to any transaction involving the use of credit reports, consumer investigatory reports, and employment background checks.
Wow, okay. So credit cards, insurance, jobs.
Exactly. Pretty much any situation where your financial character or background is being checked out. But its privacy rules do have specific exemptions.
Like what?
Well, they don't apply to disclosures of limited info to government agencies, including the FBI, particularly for counterterrorism investigations. That's a key exemption to just tuck away for the test.
Counterterrorism. Okay, that makes sense. Now, for those critical definitions, you mentioned needing to nail these for the exam. Let's get them word for word.
You're absolutely right. Understanding these precisely is, well, it's non-negotiable if you want that perfect score. Let's dive in.
Okay.
First up, a consumer report. The definition is the communication of any information by a CRA related to a consumer's creditworthiness, credit standing, credit capacity, character, personal characteristics, or mode of living, which is used or expected to be used to determine eligibility for credit or insurance for personal, family, or household purposes, evaluation for employment.
So basically, the snapshot lenders or employers use.
That's a good way to put it, your financial and personal snapshot.
Okay.
Next, a consumer reporting agency, CRA. It's all fine. Any person who, for fees or on a cooperative nonprofit basis, regularly assembles or evaluates consumer credit information to provide consumer reports to third parties.
Like the big three: Experian, Equifax, TransUnion.
Exactly like them. And it's worth noting the Dodd-Frank Act lets the CFPB supervise the bigger ones, specifically those with annual receipts over $7 million, like those three you mentioned.
Okay. What about an investigative consumer report? How's that different?
Ah, good question. An investigative consumer report is distinct. It's a consumer report that includes information on a consumer's character, general reputation, personal characteristics, and mode of living obtained through personal interviews.
Personal interviews. So talking to people.
Exactly. That personal interviews part is your key differentiator for the exam. It implies a deeper, more personal look, like someone actually talking to your neighbors or maybe past employers,
Yeah.
more involved than just pulling data.
Got it. And creditor.
A creditor is defined as any person who regularly extends, renews, or continues credit, regularly arranges for the extension, renewal, or continuation of credit, or any assignee of an original creditor who participates in the decision to extend, renew, or continue credit. Basically, anyone regularly involved in the credit granting or arranging process.
Makes sense. File.
File is straightforward. All information about a consumer that is recorded and retained by a CRA, it's just everything they have on you.
Okay. And a fraud alert.
A fraud alert is a statement in a consumer's file notifying users of a consumer report that the consumer may be a victim of fraud, which must be presented in a clear and conspicuous manner. It's basically a heads up, a warning flag for anyone pulling your report.
Right. A flag. Lastly, adverse action.
Right. Adverse action. It has the same meaning as under ETOA. It is a denial of credit or an extension of credit in a substantially smaller amount or for terms substantially different than that requested by the loan applicant. It also means any denial or unfavorable change in insurance coverage or a denial of employment based on an investigative consumer report.
So, getting turned down for a loan because of your credit score.
That's a perfect example. And if that happens, the lender has to provide a notice explaining why, giving the reason, and importantly, the CRA's contact info. That empowers you, the applicant, to see what happened and potentially fix it.
That clarifies the foundational vocabulary. Now, what specifics must be in these reports, and are there time limits on how long negative information can stick around?
Absolutely. The time limits are crucial for the exam, and yeah, they can be a common point of confusion.
Okay.
So first, what must be disclosed? If bankruptcy is on a report, it must specify the chapter, like Chapter 7 or 13, and also if the case was withdrawn.
Okay.
If a lot of inquiries recently led to an adverse action, that needs to be disclosed too. Voluntarily closed accounts. They must be reported as voluntarily closed, not just closed.
Important distinction.
Very. And here's another key detail. If a CRA gets a request for a report, but the address on the request is different from the one they have on file for the consumer, the CRA must notify the person requesting the report about that discrepancy.
Another identity theft protection measure, sounds like.
Exactly. Now, for the restrictions on information, these time limits, this is where people often get tripped up. So listen closely. Consumer reports may not include information older than these limits.
Okay, ready?
Bankruptcy cases. 10 years old, that's the longest.
10 years for bankruptcy.
Right. Then, civil lawsuits or arrest records. 7 years old, unless the statute of limitations hasn't run out yet.
7 years.
Accounts placed for collection or charged off. Also 7 years old.
7 years again.
And pretty much any other adverse information.
Well.
7 years old. Except, and this is a vital detail, except for criminal convictions. Those can always be reported, no time limit.
Wow, okay. Criminal convictions. Indefinite, that's huge.
It is. Remember that exception. But even these limits have exceptions to restrictions for really high-value transactions.
Like what kind of transactions?
For credit transactions or life insurance underwriting of at least $150,000, or for employment situations where the annual salary is at least $75,000. In those cases, older information can be included.
Okay, so $150 for credit insurance, $75K for salary. Need to remember those numbers.
Definitely commit those figures to memory for the exam.
Beyond the report itself, the credit score is obviously key.
Mm-hmm.
What does FCRA tell us about FICO scores? How are they evaluated?
Well, the first step in evaluating is always checking the identifying information for errors or potential ID theft signs. Then you look at public records, credit lines. But the FICO score itself, it's specifically designed to predict the likelihood that a consumer will become seriously delinquent on credit obligations in the 24 months immediately following scoring.
Predicts delinquency within 2 years.
Okay, and for the exam, you absolutely need to know the FICO score categories and their exact weightings. This is tested all the time.
Okay, let's hear them.
Payment history, 35%. That's the biggest chunk. Making payments on time.
35%.
Amounts owed, 30%. How much debt you're carrying relative to your limits.
30%. Still huge.
Length of credit history, 15%. How long you've had credit accounts open.
15%.
Types of credit used.
Yep.
10%. Having a healthy mix like credit cards, installment loans. 10%.
And new credit, 10%. How much recent activity, like opening new accounts or inquiries?
10%. Okay, 35, 30, 15, 10, 10. Got it.
Nail those percentages. They love asking about those.
So what about the responsibilities of the big players here? The CRAs like Equifax, the lenders who furnish the data, and us, the mortgage brokers who use these reports. What are the specific obligations under FCRA?
Understanding these obligations is absolutely critical. For compliance, yes, but definitely for getting that perfect score.
Lay it on us.
Okay, first, the obligations of CRAs. They have to disclose all information in a consumer's file if the consumer requests it. That includes where the info came from and who pulled the report recently. They also have to tell furnishers and users about their responsibilities under FCRA.
Okay, CRAs disclose and notify. What about furnishers, like lenders?
Obligations of furnishers. This is important.
Yeah.
If they provided information that turns out to be incomplete or inaccurate, they must correct it. And they have to send those corrections to all the relevant CRAs they reported to.
Okay, correction is key. Absolutely. And they cannot report information that's actively being disputed by the consumer without also noting that it's disputed.
Makes sense.
When they reported delinquency, they must provide the specific month and year the delinquency began. And here's a critical time frame for the test. If a furnisher receives notice of a dispute from a CRA, they have 30 days.
30 days to do what?
30 days to conduct an investigation, report the results back to the CRA, correct any inaccuracies with all the CRAs they report to, and if the info is indeed inaccurate, delete it. That 30-day time frame is vital.
30 days for furnishers to investigate CRA disputes. Got it.
Okay.
And finally, users, lenders, brokers like us.
Right, obligations of users. We must certify the permissible purpose for requesting a report. You can't just pull someone's credit for any reason.
Permissible purpose, check.
And if we take adverse action based on information in that consumer report, we must provide a notification to the consumer. It can be written, oral, or electronic.
The adverse action notice we talked about earlier?
Exactly. And that notice must include the CRA's contact info, a clear statement that the CRA didn't make the adverse decision, we did, and it must advise the consumer of their right to get a free copy of their report from that CRA and their right to dispute the accuracy of the information.
Okay, clear notification requirements. Anything else for users?
Yes. If the adverse action is based on information obtained from an affiliate, not directly from a CRA report, the user must also notify the consumer of their right to request disclosure of the nature of that information.
Okay, affiliate information disclosure too. Sounds like there are clear responsibilities all around. So what are the absolute no-nos under FCRA, the prohibited practices, and what happens if someone breaks these rules? Penalties.
These sections are often tested, usually in a what constitutes a violation format, so definitely pay close attention here.
Okay, prohibited practices first.
All right. A CRA is prohibited from furnishing a consumer report if they don't have reason to believe it's for a permissible purpose. Furnishers are prohibited from knowingly providing inaccurate information to CRAs. That word knowingly is important.
Knowingly inaccurate, got it.
And a CRA cannot release information in a consumer report that they know is being disputed by the consumer without clearly indicating that it is disputed.
Can't ignore disputes. Makes sense. Now the consequences. Penalties.
Right, the penalties for violations, they're different levels.
Okay.
For civil liability, for willful noncompliance, meaning they knew they were violating the act, the penalty can be actual damages suffered by the consumer or statutory damages between $100 and $1,000. Plus, they could be hit with punitive damages, court costs, and attorney's fees.
Willful means potentially higher penalties.
Definitely. Then there's civil liability for obtaining a report under false pretenses. If someone tricks a CRA into giving them a report they shouldn't have, they can be liable for actual damages or $1,000, whichever is greater, if the victim is a natural person. And they can also be liable to the CRA itself for actual damages or $1,000, whichever is greater.
So penalties for tricking the system too.
Yes. And even if the violation wasn't willful, there's civil liability for negligent noncompliance. If they were just careless, they're still liable for actual damages plus costs and attorney's fees. No statutory or punitive damages here, but still significant.
Okay, negligence still has consequences. Are there criminal penalties?
Yes, and this is distinct and important to remember. Beyond civil liabilities, there are criminal penalties.
Like jail time.
Potentially. For knowingly and willfully obtaining information under false pretenses. Fined and order imprisoned for not more than 2 years.
2 years max.
And for unauthorized disclosures by officers or employees of a CRA, If someone inside the agency knowingly and willfully gives out info they shouldn't, they can also be fined and/or imprisoned for no more than 2 years.
2 years max there, too. Okay, those criminal penalties are definitely noteworthy.
Absolutely. Remember those maximum 2-year terms.
Okay, that covers FCRA pretty thoroughly.
Yeah.
Now, building on that, we have the Fair and Accurate Credit Transactions Act, or FACTA, from 2003. What was the driving force behind this amendment? Why did we need FACTA?
FACTA was very specifically enacted, as the source says, to address the problem of identity theft, to facilitate consumers' access to the information retained by CRAs, and to improve the accuracy of consumer reports.
Identity theft focus. Okay.
Yeah, it was a direct response to the growing problem of identity theft in the early 2000s. The regulatory oversight and the types of transactions covered are generally the same as under FCRA, since FACTA amends FCRA.
Are there any specific terms or definitions under FACTA that we should highlight for the exam?
Yes, a few more key definitions emerged with FACTA, mostly related to ID theft.
An active duty alert. This is defined as a statement in a consumer's file indicating the consumer is on active military duty for the military. Helps protect service members.
Good to know.
Identity theft itself is defined as fraud or attempted fraud using the identifying information of another person. Pretty straightforward.
Right.
And an identity theft report. The FTC defines this as a report that alleges theft with as much specificity as the consumer can provide. It usually involves an affidavit from the victim and a list of the fraudulent accounts or transactions.
Okay, the official report filed by a victim. What new or expanded responsibilities did FACTA place on CRAs and on mortgage professionals like us?
FACTA really significantly expanded consumer rights and put new obligations on financial entities, especially CRAs.
How so for CRAs?
Okay, obligations for CRAs under FACTA are numerous. They now have to issue a specific victim's notice of rights when someone reports identity theft.
Big one. Each of the 3 national bureaus, Experian, Equifax, TransUnion, must provide consumers with a free copy of their credit report annually upon request. That's the free annual credit report we all know about now.
Huge for consumers.
Absolutely. CRAs must also create an initial fraud alert on a consumer's file if requested, and that stays for 1 year. If the consumer provides an identity theft report, the CRA must place an extended fraud alert, which stays for 7 years.
1 year initial, 7 years extended. Got it.
And for military personnel, an active duty alert must be kept for not less than 12 months. Also, when one national CRA receives an link request, it must notify the other 2.
So they could coordinate alerts. Good.
Yes. Consumers also gained the right to purchase their credit scores directly from the CRAs, along with specific disclosures about the score. And importantly, CRAs must block the reporting of information that a consumer identifies as resulting from identity theft, usually within 4 business days of receiving the required documentation. They also have to promptly notify the consumer if they decide not to block the information or if they later remove a block.
4 business days to block info. That's fast. Okay, what about obligations for mortgage professionals?
For obligations for mortgage professionals, we must provide applicants with information about the credit score that was used in the underwriting decision, along with a notice advising them of the score's importance.
The score disclosure notice.
Right. And if a consumer is a victim of identity theft related to a mortgage transaction, we must provide copies of the relevant application and transaction records to the victim within 30 days of their written request, provided they give proper verification of their identity and the claim.
30 days to provide records to ID theft victims.
Okay, and this is a very important practical point from FACTA, the disposal rule. This is huge for preventing identity theft from carelessly discarded documents.
Oh, shredding things.
Exactly. It applies to all users of consumer reports and requires them to take reasonable measures to protect against unauthorized access to or use of the information in connection with its disposal. For the exam, remember these examples of reasonable measures: burning, pulverizing, or shredding paper documents. And for electronic data, destroying or completely erasing electronically stored information so that it cannot be read or reconstructed.
Burn, pulverize, shred, erase. Got it.
And also, conducting due diligence on any third-party company hired to dispose of information to ensure they have compliant procedures. You can't just hand it off without checking their process. And this rule, by the way, integrates with the GLB Act's safeguards rule, which we'll get to.
Okay, disposal rule is key. Are there any additional prohibitions or specific penalties unique to FACTA itself?
Well, a key prohibition under FACTA is that businesses cannot charge a fee to an identity theft victim for providing them with those transaction records we just talked about.
Can't charge victims for their own records. Makes sense.
Right. And since FACTA is technically an amendment to FCRA, the penalties we discussed for FCRA violations apply directly to FACTA violations as well. Same penalty structure.
Okay, same penalties as FCRA.
Yeah.
Good to know. We've just covered how credit history is handled and protected. But what about the broader scope of financial data and how companies talk about their products? Let's transition to safeguarding data and advertising ethics, starting with the FTC's red flags rule. This sounds like it directly targets identity theft.
You're absolutely right. It's a direct measure against identity theft, actually included within the FACTA Act itself. It specifically addresses the detection of security breaches.
Detection.
Yes. And the definition of a red flag is crucial here. It is a pattern, practice, or specific activity that indicates the possible existence of identity theft. It's about recognizing warning signs proactively.
Who enforces the red flags rule? And how is it different from the safeguards rule? They sound similar, could be confusing.
Excellent point to clarify, as this distinction is definitely a common test question. While the CFPB leads FCRA enforcement generally for the red flags rule, authority is shared among various federal banking regulators, the NCUA and the FTC.
Okay, shared authority.
Importantly for you, as a non-depository lender or broker, you fall under the FTC's jurisdiction for the red flags rule.
FTC for us. Got it. And the distinction from safeguards.
Here's the key difference, straight from the source. The primary difference is that the safeguards rule focuses on the methods of securing personal information, and the red flags rule focuses on the methods of detecting a security breach.
Okay. Safeguards securing info prevention. Red flags detecting breaches.
Yeah, precisely. That's the core distinction to remember for the test.
Who specifically needs to comply with the red flags rule? Who does it apply to?
It applies to two main groups, financial institutions and creditors that offer or maintain covered accounts.
Okay, define those.
Sure. A financial institution is defined broadly. It includes banks, credit unions, obviously, but also any other person that holds a transaction account belonging to a consumer. A creditor is also broad, someone who regularly extends credit or arranges for the extension of credit, and the source specifically includes finance companies and mortgage brokers. So that's you.
Right.
And covered accounts are accounts offered or maintained primarily for personal, family, or household purposes that involve or are designed to permit multiple payments or transactions. Mortgage loans are explicitly cited as an example of covered accounts.
So basically, mortgage lenders and brokers dealing with standard consumer mortgage accounts need to comply.
That's the bottom line.
So what must these entities actually do? What are the requirements for their identity theft prevention programs under the red flags rule?
They have to establish a formal written identity theft prevention program. And this program isn't just a piece of paper. It has to have clear provisions for doing four key things.
Okay, what are the four?
1. Identifying patterns, practices, or specific activities that may indicate the possible existence of identity theft. Basically, knowing what red flags look like for your business.
Identifying risks.
2. Detecting irregularities when obtaining information from a person opening an account or accepting a change of address on existing accounts. This means being vigilant during common customer interactions, spotting things that seem off.
Detecting red flags in practice.
3. Preventing and mitigating identity theft by responding appropriately to the types of risks posed by particular types of accounts, having procedures in place for what to do when a red flag is detected.
Responding to risks.
And 4, crucially, updating the identity theft program periodically to identify new risks to the security of personal information. Because identity theft tactics evolve, the program has to evolve too. It can't be static.
Okay, identify, detect, respond, update. Got it. Any examples of red flags?
The rule provides examples, like receiving alerts or warnings from a CRA, seeing suspicious documents that look forged or altered, noticing personal identifying information that's inconsistent with other records, observing unusual activity on an account, or getting direct notices from customers or law enforcement about possible identity theft.
Okay, red flags covered. Let's transition to the Gramm-Leach-Bliley Act, or GLB Act. This one focuses heavily on consumer privacy, right?
That's right. The privacy provisions of the GLB Act, sometimes called GLBA, aim to ensure that financial institutions, including mortgage brokers and lenders, protect non-public personal information of consumers.
Protecting NPI, non-public personal information.
Exactly. Its core requirements boil down to three things: advising consumers of your privacy policies, giving them a chance to limit some types of information sharing, the opt-out, and creating a comprehensive security program to protect the data.
Who enforces GLB?
The CFTB is responsible for enforcing the privacy provisions, specifically through Regulation P. Remember, Regulation P implements the GLB Act privacy provisions.
Reg P for privacy. Okay.
And the GLB Act also requires compliance with the Safeguards Rule. This is the rule enforced by the FTC that requires financial institutions to have measures in place to keep customer information secure.
So GLB mandates privacy notices, Reg P, and data security, Safeguards Rule.
You got it. They work together.
Now, this act has specific definitions that can be tricky, especially distinguishing between a consumer and a customer. Let's get crystal clear on these for the exam.
Absolutely. These distinctions are prime exam question territory because they determine when certain privacy notices are required. Big difference in obligations.
Okay, let's start with NPI. What exactly counts?
Okay, non-public personal information, NPI. The law defines NPI as a personally identifiable financial information provided by a consumer to a financial institution, resulting from any transaction with the consumer or any service performed for the consumer, or otherwise obtained by the financial institution.
So pretty much any personal financial data they get from you or about you.
Generally, yes. Examples include info you give on a loan application, your account balance or transaction history, even the simple fact that you are a customer of that institution. Information collected through internet cookies can also be NPI. Importantly, information from a consumer report is also considered NPI.
What's not NPI then?
Publicly available information is excluded. Things like information in government real estate records, stuff you'd find in a phone book or on an unrestricted website, or a listed phone number provided by a customer. That's not protected as NPI.
Okay, public info is out. Now for the big one. Consumer versus customer.
Yes. This is vital for the exam. Listen closely.
Okay.
A consumer is defined as an individual who obtains from a financial institution financial products or services which are to be used primarily for personal, family, or household purposes. Think of this as someone who has a more casual or isolated transaction. Maybe they used an ATM once or got a wire transfer.
A one-time interaction, sort of.
Kind of. Now, a customer. A customer is a consumer who has established a customer relationship with the financial institution. This gives them greater privacy protections. A customer relationship exists when, for example, you enter an agreement for the consumer to obtain a loan, or enter into an agreement or understanding for the brokering or arranging of a home mortgage loan, or have an agreement for the financial institution to service the consumer's loan.
So an ongoing relationship, like getting a mortgage or having it serviced.
Exactly. A customer has that continuing relationship, whereas a consumer might just be passing through. This distinction is crucial because it dictates when the initial and annual privacy notices are required.
Got it. And financial institution under GLB.
It's defined broadly in Regulation P to include entities like non-bank mortgage lenders, mortgage brokers, and mortgage loan originators, because the activities they engage in are considered financial in nature. So it definitely applies to you.
Right. Okay, so when do these privacy notices actually need to go out? The timing and types of disclosures seem critical.
Timing and specifics are indeed key here. Definitely potential exam questions.
Let's break it down. Initial privacy notice.
Okay, the initial privacy notice. This describes the institution's information sharing practices. Now, for consumers, those one-off folks, it's generally not required unless the institution plans to share their NPI with non-affiliated third parties outside of certain exceptions.
But for customers?
For customers, ongoing relationship, the initial privacy notice is always required. It must be a clear, conspicuous notice in writing or electronic form, and the timing is critical. It's due at the time the customer relationship is established.
When the relationship starts.
Got it.
What about the opt-out notice?
The opt-out notice. If the institution does intend to share NPI with non-affiliated third parties, again, outside of specific exceptions, both consumers and customers must be given this notice before the sharing happens. It has to explain what info might be shared and provide a reasonable means for them to opt out.
Reasonable means? Like how long do they get?
Good question. Reasonable means includes things like easy-to-use forms or toll-free numbers. And the time frame is usually 30 days for the consumer to respond if the notice is mailed. For online accounts, it's generally 30 days from when the consumer acknowledges receiving the electronic notice. For isolated transactions, the opt-out must be available immediately. Remember that 30-day window?
30 days to opt out.
Okay.
And the annual notice.
Right, the annual privacy notice. This is required only for customers. It must be provided annually throughout the customer relationship. It basically contains the same information as the initial notice, including reminding them of their opt-out rights, if applicable.
Annually for customers. Is there any way out of sending that every year?
Yes, there's an important exception. An institution is not required to provide an annual notice if two conditions are met. First, it only shares NPI with non-affiliated third parties under specific exceptions that don't trigger opt-out rights, like for joint marketing agreements or processing transactions. And second, the institution's privacy policies and practices haven't changed since the last notice was sent.
Okay, so if nothing changes and sharing is limited, maybe no annual notice.
Correct. But this leads to another tricky area: online delivery of the annual privacy notice. This can be confusing.
How so?
An institution can satisfy the annual notice requirement by simply posting it online if, and only if, all of these specific conditions are met.
Okay, list them out.
1. The sharing practices do not trigger customer opt-out rights. 2. Any applicable FCRA opt-out notices were already provided. 3. The information in the privacy notice hasn't changed since the last one. 4. The institution uses the model privacy form provided in Regulation P5. The notice is posted continuously on their website, clearly and conspicuously on a page that does not require a login to access.
Wow, that's a lot of conditions.
It is, and even if they meet all those, they still have to mail a paper notice to any customer who requests one by phone, and they have to do it within 10 days of the request.
Okay, online posting is possible, but very restricted. Given all these disclosure rules, what can companies not do under GLB? Prohibited practices.
Yes, there are key prohibitions aimed at protecting sensitive data. A big one is that financial institutions generally cannot share customer account numbers with non-affiliated third parties for marketing purposes, though there are limited exceptions, like sharing with the CRA.
Okay, no sharing account numbers for marketing.
Right. And the law also limits how third parties, once they receive NPI, can redisclose or reuse that information. It tries to keep the information contained.
Let's shift gears to advertising ethics now. The Mortgage Acts and Practices Rule, or MAP rule, it's also known as Regulation N. This sounds like it's designed to keep mortgage advertising honest.
That's exactly right. Its purpose is clearly stated: to address misrepresentations in the advertising of mortgage products, keeping ads truthful and not misleading.
Who enforces this one? CFPB again.
The CFPB has primary enforcement authority, yes, but it shares some authority with the FTC.
And who does it apply to? All mortgage advertisers.
It applies very broadly to mortgage lenders, brokers, servicers, and others who engage in mortgage advertising, which can even include real estate agents or ad agencies working for them.
Okay, broad application. Any exceptions?
Yes, and this is a critical exemption to know for the exam. The MAQ rule does not apply to banks, savings and loan institutions, federal credit unions, or other entities that are excluded from the FTC's jurisdiction.
So depository institutions are generally exempt from this specific rule. Very important.
Extremely important distinction. Now, two key definitions under MAP.
Go ahead.
A commercial communication, this is defined as any written or oral statement, illustration, or depiction designed to effect a sale or to create interest in purchasing goods or services regardless of the medium. So it covers print ads, radio spots, TV commercials, telemarketing scripts, website content, even scripts used for on-hold messages.
Very broad definition of advertising.
Very. And a mortgage credit product is defined as any form of credit that is secured by real property or a dwelling, and that is offered or extended to a consumer primarily for personal, family, or household purposes.
Okay.
Basically, most consumer mortgages.
Okay, this seems like a big one for compliance, given how much mortgage advertising is out there. What specific types of misrepresentations are forbidden under the MAP rule? What can't advertisers say?
This is indeed a critical area, and the rule is quite detailed. The core prohibition is against material misrepresentations, whether they are made expressly or by implication, in any commercial communication regarding any term of any mortgage credit product.
Material misrepresentations, meaning?
An act or practice is considered deceptive and thus a misrepresentation if it's likely to mislead a consumer acting reasonably under the circumstances, and if the misrepresentation is material, meaning it's likely to affect the consumer's choice or conduct regarding the product.
Likely to mislead a reasonable consumer. Okay, what are some examples?
The rule provides a long list, but for the exam, focus on the types of misrepresentations. Here are the key categories. Misrepresentations of loan terms. This is huge. Things like misrepresenting the interest rate, maybe advertising a low introductory rate without clearly stating it's adjustable, or failing to mention that unpaid interest gets added to the principal, negative amortization.
Okay, interest rate tricks.
Right. Also, misrepresenting the APR, the simple annual rate, or other rates, using the word fixed misleadingly when the rate or payments can change. Misrepresenting prepayment penalties. Falsely implying a loan type, like advertising a non-amortizing loan as if it were fully amortizing. Misrepresenting the potential for default, or the consequences of not paying taxes and insurance. Or misrepresenting the consumer's right to reside in the dwelling, which is especially relevant for reverse mortgages.
Lots of ways to mislead on terms. What about fees?
Misrepresentations of fees and costs. Making false claims about the fees or costs associated with the loan. Misrepresenting whether taxes and insurance are included in an advertised monthly payment, that's a common one, implying they're included when they're not. Also, misrepresenting the consumer's ability to actually obtain the advertised product, like using terms like pre-approved or guaranteed when it's not really true, or misrepresenting the ability to refinance or modify the loan later.
Pre-approval claims need to be real. Got it. Payments.
Misrepresentations of payments and consumer savings. Providing misleading rate or payment information that isn't actually available for the full loan term. Making false claims about the amount of cash or credit a consumer will receive. For reverse mortgages, a classic example is advertising no mortgage payments, without clearly and conspicuously clarifying that the borrower still must pay taxes and insurance.
The no payments claim needs context. Okay. Anything else?
Misrepresentations regarding additional affiliated services. Making false claims about other products sometimes sold with the mortgage, like credit insurance. Critically, misrepresenting an association with the government, like using government logos or symbols deceptively to imply endorsement. Falsely claiming to be the consumer's current lender or servicer to trick them into refinancing. And making deceptive claims about the availability or nature of counseling services.
Can't pretend to be the government or the current servicer. Okay. Are there any other specific compliance rules under MAP, particularly regarding record keeping?
Yes, 2 important points. First, the MAP rule explicitly prohibits any person from obtaining or attempting to obtain a waiver from any consumer, which causes them to waive any of the protections extended by the rule. Basically, you can't make consumers sign away their rights under Regulation N.
No waivers allowed.
Correct. And second, record keeping. This is crucial for the exam. Entities subject to the MAP rule must keep copies of their commercial communications regarding mortgage credit products for 24 months.
24 months. How is that measured?
That 24-month period is measured from the last date on which the person made or disseminated the communication. So from the last time the ad ran or the script was used. That 24-month time frame is incredibly important for the test. Remember, 2 years for MAP rule records.
24 months. Got it. We live in a digital age, obviously, and electronic signatures are everywhere. What does the e-Sign Act say about their validity? And what are the crucial definitions we need here?
Right. The Electronic Signatures in Global and National Commerce Act, or e-Sign Act. It's a federal law, and its main point is to ensure that a signature, contract, or other record cannot be denied its legal effect, validity, or enforceability solely because it is in electronic form.
So e-signatures are legally valid, just like paper ones.
Basically, yes.
Yeah.
It validates digital transactions. For your exam, you absolutely need to know these key definitions verbatim from the source.
Okay.
An electronic record. This is a contract or other record that is created, generated, sent, communicated, received, or stored by electronic means. Pretty much any digital document.
Got it. Electronic signature.
An electronic signature. This is defined as an electronic sound, symbol, or process that is attached to or logically associated with a contract or other record, and that is executed or adopted by a person with the intent to sign the record. It's the digital equivalent of putting pen to paper, showing intent.
Sound, symbol, or process.
Okay.
And record.
And a record is simply information that is inscribed on a tangible medium or that is stored in an electronic medium that may be retrieved. Covers both physical and electronic forms.
Okay, definition's clear. What are the specific rules for getting consumer consent to use electronic records? Can we just assume they're okay with it?
Absolutely not. Electronic records can satisfy legal requirements to provide information in writing only if the consumer affirmatively consents to receive the information electronically, and they must not have withdrawn that consent.
Affirmatively consents. So they have to actively agree.
Yes, implied consent isn't enough. They have to take some action to show they agree. And before you even get their consent, the financial institution must provide a clear and conspicuous statement informing the consumer of all of the following. These points are crucial for the exam as they detail the scope of the consent and the consumer's rights.
Okay, what needs to be disclosed before consent?
First, any right or option to have the record provided or made available on paper or in a non-electronic form, how the consumer may request a paper copy, and any applicable fees. They need to know they can still get paper if they want.
Right, it's a paper copy.
Second, the right to withdraw consent, including applicable conditions. Fourth, whether consent applies only to the particular transaction that triggered the disclosure or to specified categories of records that may be provided over the course of the relationship. Is this consent just for this one thing or for everything going forward?
Scope of consent.
Fifth, a description of procedures for the consumer to update information necessary to be contacted electronically, like updating their email address.
Updating contact info.
And sixth, the hardware and software requirements for access to and retention of electronic records. What equipment or programs do they need to actually view and save the documents?
Tech requirements. Wow, that's a comprehensive list.
It is, and there's one more piece. The way the consumer gives electronic consent must reasonably demonstrate that they can actually access the information in the electronic format that will be used. Like, they might have to click a link in an email sent to the address they provided.
Prove they can actually get the electronic docs. Okay. Can all records be kept electronically under e-sign, or are there limits?
Good question. If another law requires a record to be maintained for a certain period, the e-sign Act does allow that record to be kept electronically if it meets 3 specific conditions.
What are they?
1. The electronic record must accurately reflect the information set forth in the document. It has to be a true copy.
Accurate reflection.
2. It must remain accessible to all persons who are entitled to access it for the required retention period. People who need to see it must be able to get to it for as long as required.
It's accessible.
And 3, and it must be kept in a form that is able to later be accurately reproduced. You need to be able to print it or view it reliably later on.
Reproducible, okay. Any types of records that don't count?
Yes, and this is a crucial exclusion, definitely important for the exam. Oral communications, or a recording of an oral communication, do not qualify as an electronic record under the Act.
So a recording of a phone call isn't an e-sign compliant electronic record.
Correct. If a law requires something to be provided in writing, just recording the phone call where you discussed it, it won't satisfy that requirement under e-sign.
Okay, e-sign done. Now, for those sometimes annoying telemarketing calls, let's talk about the Do Not Call Registry. What's its main purpose and what laws govern it?
Right, the National Do Not Call Registry, or DNC. This is governed primarily by the Do Not Call Implementation Act and the FTC's Telemarketing Sales Rule, TSR. Its purpose is pretty simple. Allow consumers to register their phone numbers to limit the number of unwanted telemarketing calls they receive.
And once you're on the list?
Once a number is registered, it stays on the registry permanently unless the consumer removes it or discontinues the number.
Permanently. Good. Who oversees this?
It's a bit shared. The FTC generally covers interstate calls. The FCC covers intrastate calls. And because of the Dodd-Frank Act, the CFPB also shares enforcement authority related to financial services.
Okay, multiple agencies involved. Who does it apply to?
It applies broadly to any business or individual engaged in the practice of telemarketing, which is generally defined as calls made to persuade consumers to purchase goods or services.
Okay. What are the rules telemarketers absolutely must follow and what's strictly forbidden? Any key timeframes here?
Yes, there are definite rules and some critical timeframes that are frequently tested.
Lay them out. Required disclosures.
Okay, first, required verbal disclosures. During a telemarketing call, mortgage professionals must provide truthful and prompt verbal disclosures of the identity of the caller, the fact that the purpose of the call is to sell goods or services, the nature of those goods services being offered, and if it's a promotion or prize giveaway, they must assure the consumer that no purchase or payment is required to win or participate.
Clear disclosures up front. Makes sense. What about using the DNC registry itself?
This is a big one for compliance. Businesses making telemarketing calls must access the DNC registry and update their call lists, removing any newly registered numbers at least every 31 days.
Every 31 days. That's a critical number for the exam.
Absolutely. Remember that 31-day scrubbing requirement?
Okay. Record keeping.
Yes, record keeping. Records related to telemarketing activities must be maintained for 24 months from the date the record is produced.
24 months again. Same as the MEP rule.
Correct. 2 years for telemarketing records. Now for the prohibited abusive practices.
What can't they do?
They cannot use threats, intimidation, or profane language. They cannot place calls before 8 a.m. or after 9 p.m. in the consumer's local time zone. That local time zone part is important.
8 a.m. to 9 p.m. local time. Got it.
They can't make false or misleading statements. They can't request or receive payment of any fee in advance for help obtaining a loan or credit when they've guaranteed likelihood of success. They can't charge a consumer for goods or services without the consumer's explicit, verifiable authorization. They can't fail to transmit accurate caller ID information. And of course, the big one. They cannot initiate a call to a consumer whose number is on the DNC registry unless a specific exception applies.
Okay, quite a list of prohibitions. Are there exceptions to calling numbers on the DNC registry?
Yes, and this is a very important one for the exam. The established business relationship, EBR exception.
EBR, how does that work?
A mortgage professional can legally call a consumer, even if their number is on the DNC registry, if an EBR exists. An EBR can be established in 2 ways.
Okay.
First, if the consumer had a transaction with the company within the 18-month period immediately preceding the date of the sales call. So a past customer within the last year and a half.
18 months for past customers.
Right. Second, if the consumer made an inquiry or submitted an application to the company, that creates an EBR allowing contact for 3 months following the date of the inquiry or application.
3 months for inquiries.
Yeah.
Okay, 18 months for transactions, 3 months for inquiries.
Exactly. Those timeframes are key. However, there's a crucial override. Regardless of whether an EBR exists, if a consumer specifically asks the company not to call them again, that company-specific request must be honored. The EBR doesn't trump a direct "do not call me" request to that specific company.
Specific requests always win. Good.
Yeah.
What about penalties for violating DNC rules?
Violations of the telemarketing sales rule are considered unfair and deceptive trade practices. The penalties can be quite steep. The maximum civil penalty is currently $53,088 for each violation.
Wow, over $53,000 per call.
Per violation, yes. And critically, the source notes that when violations continue, each day is considered a separate violation. So the penalties can escalate very quickly if a company keeps violating the rule. That specific penalty amount and the daily violation rule are vital for your test.
$53,088 per violation per day. That's serious. Okay, shifting gears now to national security and combating financial crime. Let's talk about the USA Patriot Act. What's its overarching goal and how does it define money laundering?
Right, the Uniting and Strengthening America by providing appropriate tools required to intercept and obstruct terrorism act, or Patriot Act for short. Title III of this act is specifically focused on strengthening laws against money laundering. Congress explicitly stated that money laundering provides the financial fuel that permits transnational criminal enterprises to conduct and expand their operations. So the goal is to cut off that fuel supply.
Makes sense. How do they define money laundering itself?
For your exam, the verbatim definition is critical. The filtering of ill-gotten money through a series of transactions in order to prevent the tracing of the funds to their original illegal source. It's about making dirty money look clean.
Filtering dirty money. Got it. Who's the main agency here?
The Department of Treasury, through its specialized agency, the Financial Crimes Enforcement Network, or FinCEN, has primary responsibility for implementing and enforcing these provisions.
FinCEN, okay. What's the scope? Who has to comply?
The requirements of Title III apply broadly to financial institutions, and that term is defined very broadly under the Act, including 24 specific types of entities. Notably for our discussion, this list includes persons involved in real estate closings and settlements and loan or finance companies.
Loan or finance companies. Does that include us? RMLOs?
Right.
Residential mortgage lenders and originators? There seems to be a distinction sometimes.
Yes, and this is indeed a prime exam question area. FinCEN has specifically clarified that the term loan or finance company does include non-bank residential mortgage lenders and originators, RMLOs. So yes, it applies.
Okay, RMLOs are covered. What's the distinction then?
Here's the crucial distinction for the test. The SAFE Act definition refers to an individual loan originator, while FinCEN expressly states its rule applies to the company, including sole proprietorships, and not an individual employee. The employing company is ultimately held liable for compliance failures.
Ah, so the Patriot Act FinCEN rules apply to the RMLO company, not the individual MLO employee directly, unlike the SAFE Act.
Exactly. The company bears the responsibility for compliance. RMLOs are included, FinCEN says, because they are in a unique position to assess and identify money laundering risks and fraud while directly assisting consumers with their financial needs.
Okay, company liability. Makes sense. So what are the specific actions these RMLO companies must take to comply with the Patriot Act and FinCEN's requirements?
RMLOs have several critical obligations under these rules. They fall into a few key categories.
Let's hear them.
First, they must establish a customer identification program, CIP. This is fundamental.
CIP. What does that involve?
A compliant CIP must include procedures to collect specific identifying information from customers like name, date of birth, address, and an identification number like an SSN or passport number. Then, verify that information using reliable documents or non-documentary methods. Then, maintain records of the information collected and the verification efforts for 5 years after the account is closed. Compare the customer's identity against government lists of known or suspected terrorists. And finally, notify customers either verbally or in writing that the institution needs to verify their identity.
Collect, verify, record, 5 years. Compare, notify. That's CIP. What else?
Second, RMLOs must create and implement an anti-money laundering AML program. This has to be a written program approved by senior management. Its purpose is that it is reasonably designed to prevent the loan or finance company from being used to facilitate money laundering or the financing of terrorist activities.
A written AML program. What needs to be in it?
At a minimum, it must include compliance with the reporting and record-keeping requirements of the Bank Secrecy Act, which we'll touch on, the designation of a specific compliance officer responsible for the AML program, provisions for ongoing employee training regarding their AML responsibilities, and procedures for independent testing or auditing to ensure the program is actually working.
Compliance officer. Training, testing. Got it. Third requirement.
Third, they must file suspicious activity reports, SARs, with FinCEN. RMLOs must file SARs if they know, suspect, or have reasons to suspect that a transaction involves funds derived from illegal activity, is designed to evade BSA requirements like structuring, appears to serve no business or lawful purpose, or involve the use of the RMLO to facilitate criminal activity.
Okay. SARs for suspicious stuff. What's the process?
Individual mortgage loan originators should generally report suspicious activity internally to the company's designated SAR manager or compliance officer, who then determines if a SAR needs to be filed. The filing deadline with FinCEN is generally within 30 days after the date of the initial detection of facts that constitute a basis for filing.
In 2 days after detection.
Right. And if the situation requires immediate attention, like ongoing terrorist financing or money laundering, the RMLO should immediately notify appropriate law enforcement by telephone in addition to filing the SAR.
Okay. Immediate call for urgent situations. Record keeping for SARs.
Yes. RMLs must maintain copies of SARs filed and the supporting documentation for 5 years from the date of filing. And importantly, RMLOs generally have civil liability protection, a safe harbor for filing SARs, meaning they can't be sued for reporting suspicious activity in good faith.
5 years for SAR records. Safe harbor is good. Any other required actions?
Lastly, RMLOs must also report receipt of currency, cash or cash equivalents, in excess of $5,000. This often ties into BSA reporting, which we'll get to.
Okay. What are the absolute no-nos, the prohibited practices under the Patriot Act related to these requirements?
2 main prohibited practices to remember. First, opening a new account without verifying the identity of the customer in accordance with the established CIP procedures.
We can't skip the CIP.
Right. And second, critically, it is prohibited to advise or notify a person who is the subject of a SAR that the SAR has been filed about their activities. This is known as tipping off and is a serious offense designed to protect the integrity of investigations.
No tipping off suspects. Very important. Okay, you mentioned the Bank Secrecy Act. BSA and AML often go hand in hand with the Patriot Act. What's the main goal of the BSA itself?
Right, they're closely related, but BSA came first. The Bank Secrecy Act, formerly the Currency and Foreign Transactions Reporting Act of 1970, was originally designed to prevent the U.S. financial services industry from being used to launder money. It predates the Patriot Act significantly, but forms the foundation for much of its AML framework. FinCEN enforces BSA as well.
So, preventing the financial system from being used for money laundering. What are its specific goals?
The main goals are preventing and detecting money laundering and the financing of criminal activity, documenting large currency transactions, and improving the reporting and investigative tools available to law enforcement for financial crime investigations.
Okay. What are the specific requirements under BSAM, particularly regarding reporting and record keeping? It sounds like there's overlap with Patriot Act requirements.
There is definitely overlap, particularly with the AML program and CIP, but BSA has some distinct reporting and record-keeping requirements you need to know. First, as mentioned under Patriot Act needs, institutions need that written AML program approved by the board. Minimums include internal controls, independent auditing, designating compliance individuals, and providing staff training.
Right, the AML program. What about specific reports?
This is key BSA territory. Currency Transaction Report, CTR. Financial institutions must file a CTR with FinCEN for any single transaction or series of related transactions in currency, cash, exceeding $10,000 conducted by or on behalf of one person in a single business day. This also applies to structured transactions, breaking up a large cash transaction into smaller ones to try and avoid the $10,000 threshold.
CTR for cash over $10. Got it.
Negotiable instrument purchases. Financial institutions must keep records of cash purchases of negotiable instruments like money orders, cashier's checks, when the amount is between $3,000 and $10,000 inclusive. This helps track potentially suspicious movement of funds below the CTR threshold.
Record keeping for 3K, $10K instruments. Okay.
Suspicious activity report. As we discussed, recording and reporting suspicious activities to FinCEN is a requirement under both frameworks. Wire transfers. Institutions must keep records of wire transfers exceeding $3,000 regardless of whether they are the sender's or recipient's institution.
Records for wires over 3K.
Customer Identification Program, CIP, again, same requirement as under the Patriot Act. IRS Form 8300, this is slightly different. While RMLOs themselves might not file CTRs directly for transactions involving the receipt of more than $10,000 in cash and cash equivalents, like in a loan closing, the person receiving the cash, often the escrow or settlement service provider, must file IRS Form 8300, report of cash payments, over $10,000 received in a trade or business. A copy goes to FinCEN, so they still get notice of large cash transactions in the mortgage process this way.
Form 8300 for cash over $10 in closings. Okay. Can you detail the SAR filing triggers under BSA a bit more? When exactly must the SAR be filed?
Sure. Financial institutions are generally required to file a SAR for known or suspected criminal violations committed against the institution or involving insiders, regardless of dollar amount, or for transactions aggregating $5,000 or more where they suspect money laundering, BSA evasion, lack of lawful purpose, or use of the institution for criminal activity.
$5,000 threshold for suspected illegal activity SARs.
Right, if there's a suspect identified. If there's no suspect identified, the threshold for reporting criminal violations rises to $25,000. But for suspected money laundering or BSA evasion-type activities, the threshold is $5,000, regardless of whether a suspect is identified.
Okay, $5K if suspect ID'd or for laundering suspicion, $25K if no suspect for other criminal acts. Got it. Filing process.
Filing must be done no later than 30 calendar days after the date of initial detection of the facts constituting a basis for filing. It's filed electronically using FinCEN's BSA e-filing system, specifically SAR Form 111.
30 days again, and record retention.
Same as under Patriot Act. A copy of the filed SAR and all supporting documentation must be maintained for 5 years from the date of filing. And regarding privacy, the Right to Financial Privacy Act specifically does not prevent disclosure of information to FinCEN or bank supervisory agencies for carrying out their functions. SAR reporting is protected.
5 years for SAR records under BSA 2. Consistent. Okay, let's move into a truly massive piece of legislation. The Dodd-Frank Wall Street Reform and Consumer Protection Act. What was its overarching purpose? It came after the 2008 crisis, right?
Exactly. Dodd-Frank was a direct, sweeping response to the financial crisis. It addresses a huge range of financial issues, but for our purposes, its goal was fundamentally to set the regulatory boundaries for the origination and securitization of mortgage loans and broadly reform the financial system to prevent a similar meltdown.
Setting boundaries for mortgages. Got it. It's enormous. Which specific titles should we focus on for the SAFE exam, especially those affecting mortgages?
While many titles have indirect effects, these are critical for you to know. Title IX. Investor protections and improvements to the regulations of securities. This tightened regulation of investors and, importantly, credit rating agencies.
Title IX, okay.
Title X, the Consumer Financial Protection Act of 2010. This is monumental because it's the title that actually authorizes the creation of the CFPB and transferred authority for many consumer protection laws to this new agency.
Title X created the CFPB.
Huge. And Title 14th, The Mortgage Reform and Anti-Predatory Lending Act. This title applies directly to mortgage originators, servicers, and appraisers. This is where many of the rules directly impacting your day-to-day work come from.
Title 14, Mortgage Reform. Sounds like the core for us. Let's break down its key subtitles.
Yes. Title 14 is where the rubber really meets the road for non-depository loan originators. Let's look at the key subtitles. Subtitle A, Residential Mortgage Loan Origination Standards. This is where rules came from, prohibiting incentives for loan originators to steer consumers towards riskier or higher cost loans just to get paid more. It created limitators on loan originator compensation structures.
LELO comp rules started here.
Subtitle B, Minimum Standards for Mortgages. This subtitle directed the newly formed CFPB to establish standards for determining a borrower's ability to repay, ATR, their mortgage. It also instructed the CFPB to create rules defining a qualified mortgage, QM, which would provide a presumption, either conclusive or rebuttable, that the ATR standard was met.
ATR and QM rules mandated here, big ones.
Subtitle C, High-Cost Mortgages. This significantly amended the Home Ownership and Equity Protection Act, HOEPA. It extended HOEPA's protections to purchase money mortgages and open-end home equity lines of credit, HLOCs, not just refinances. It also lowered the interest rate and points and fees thresholds that trigger APA coverage, making more loans subject to its stricter rules.
Expanded HEPA coverage.
Yes, and here's a crucial detail for your test from Subtitle C. It adds a prepayment penalty trigger. A loan is now considered high cost under HEPA if a prepayment penalty is enforced for more than 36 months after closing, or if the penalty amount could exceed more than 2% of the amount prepaid.
Those exact figures, 36 months and 2%, are critical HEPA triggers introduced by Dodd-Frank.
36 months, 2% prepayment penalty trigger for HEPA.
Got it. Subtitle C also imposed mandatory homeownership counseling requirements for high-cost loans and strengthened prohibitions against certain risky loan terms and predatory practices.
Okay, what else in Title 4? Subtitle D, Authorize the creation of an Office of Housing Counseling within HUD. Subtitle E, Mortgage Servicing. This mandated a whole slew of new rules for mortgage servicers, covering things like requirements for periodic statements, reminders before interest rates reset, limitations on force-placed insurance, obligations to work with borrowers to avoid foreclosure, rules for prompt payment crediting and error correction, requirements for delinquent borrowers to have access to servicing personnel, and standards for evaluating borrowers for foreclosure avoidance options. Huge changes for servicing.
Servicing rules overhaul.
Subtitle F, Appraisal Activities. Required stricter appraisal standards, particularly for higher-risk mortgages, and included rules designed to ensure appraiser independence from lenders and brokers. Subtitle G, Mortgage Resolution and Modification. Required servicers, if they deny a loan modification request, to provide the borrower with the net present value NPV analysis data used in the decision. It also required them to make an NPV calculator available online.
NPV requirements for modifications.
And subtitle H, Miscellaneous Provisions. This included things like acknowledging the need for reform of Fannie Mae and Freddie Mac and mandating a study on foreclosure rescue scams and loan modification fraud.
Okay, Title 4.6 packed a punch. Now, Dodd-Frank didn't just lay out these principles. It specifically told the CFPB to develop detailed rules. Which specific CFPB rules that we deal with today are direct results of Dodd-Frank mandates?
You're exactly right. The Act ordered the CFPB to flesh out these requirements with specific regulations. For the exam, you should definitely recognize these key rules by name and their associated regulation, mostly Regulation Z under TILA or Regulation X under RSPA.
Okay, which ones?
The ability to repay qualified mortgage rule, ATR-QM rule, Regulation Z. The 2013 HOEPA rule, implementing the Subtitle C changes, Regulation Z, and related homeownership council amendments, Regulation X. The Loan Originator Compensation Rule, Regulation Z, Eco-Evaluations Rule, requiring copies of appraisals be given to borrowers. Regulation B, TILA HPML Appraisals Rule, stricter appraisal rules for higher-priced loans. Regulation Z, the TILA Escrow Requirements Rule, expanding mandatory escrows. Regulation Z, and finally, the TILA NRSPS Servicing Rules, implementing the Subtitle E changes, Regulations X and Z.
Wow, okay, so ATR-QM, ATIPA, low comp, appraisal rules, escrow rules, servicing rules, all stem directly from Dodd-Frank mandates to the CFPB.
That's the lineage. Dodd-Frank set the stage, CFPB wrote the detailed script.
Let's dive deeper into two of those huge ones. The ability to repay, ATR and qualified mortgage, QM rules. First, a practical matter. How long do creditors need to keep records for ATR-QM compliance?
Good question to start with. Creditors must retain records demonstrating compliance with the ATR-QM rules for at least 3 years after the consummation closing of a covered mortgage loan.
3 years for ATR-QM records. Got it. Now, let's break down the ability to repay rule itself. What's its core purpose and what's its scope? Who does it apply to?
The ATR rule essentially outlines underwriting factors and acceptable documentation and verification to use in determining a borrower's ability to repay their loan. Its core purpose is straightforward: to ensure that lenders make a reasonable, good faith determination before closing the loan that the consumer has the actual ability to repay the mortgage according to its terms.
Makes sense. Prevent loans people can't afford. What's the scope?
The scope is very broad. It applies, according to the rule, to any consumer credit transaction secured by a dwelling. That includes first lands, subordinate lands, loans secured by a principal residence, or even a second home or investment property, that's consumer credit, refinances, and closed-end home equity loans. Pretty much most standard mortgage loans.
Very broad. Are there any specific transactions that are exempt from the ATR rule? This sounds like a potential point of confusion.
Yes, there are specific exemptions, and knowing these is key for the exam. The ATR rule does not apply to open-end home equity plans, HELOCs, reverse mortgage loans, bridge loans with terms of 12 months or less, intended for purchasing a new dwelling, construction loans, specifically the construction phase of construction to permanent loans, and loans made by a housing finance agency.
Okay, ATROs, reverse, short bridge loans, construction phase, HFA loans are exempt from ATR. Good to know. Now, ATR requires considering several factors to determine repayment ability. You mentioned underwriting factors. What are the specific factors creditors must consider?
Yes, the rule lays out 8 specific underwriting factors that creditors are required to consider and document when making that reasonable good faith determination of repayment ability. You absolutely need to memorize this list for the exam.
Okay, the 8 ATR factors. Let's hear them.
1. Current or reasonably expected income or assets, other than the value of the dwelling and any real property attached to it. Can't count the house itself as ability to pay for the house.
Income assets, not the collateral.
2. Employment status, if the creditor is relying on income from employment to determine repayment ability. Is the job stable?
Employment status.
3. Monthly payments on the loan calculated in accordance with the provisions of the rule. The P&I payment based on specific calculation rules.
Proposed loan payment.
4. The amount of the consumer's payments on any simultaneous loan known to the creditor, like a second mortgage taken out at the same time.
Simultaneous loans.
5. Monthly payments for mortgage-related obligations such as homeowners insurance, taxes, insurance, HOA, dues, the full housing expense.
Mortgage-related obligations, PITI plus.
6. Debt obligations such as alimony and/or child support. Other required monthly debt payments.
Other debts.
7. Monthly debt-to-income ratio or residual income, calculated in accordance with provisions of the rule, the DTI ratio, or how much money is left over. DTI, residual income.
And 8, credit history. Past performance predicts future performance.
Credit history, okay? Those are the 8. And verification.
Yes, the ATR rule requires that the creditor verify all this information using reasonably reliable third-party records. You can't just take the borrower's word for it. Examples include IRS tax return transcripts, filed tax returns, payroll statements, financial institution records, employer records, etc.
Third-party verification needed. How are the payments calculated for Factor 3?
The payment calculation is specific. For Factor 3, the monthly loan payment, it must be calculated using the fully indexed rate or the introductory interest rate for an ARM, whichever is greater, and assuming monthly fully amortizing payments that are substantially equal.
Fully indexed rate, fully amortizing payment. Can't use just the low teaser rate.
Exactly. The fully indexed rate is the index rate plus the margin at the time of closing. The creditor can use a reasonable look-back period for the index as defined in the loan agreement.
Okay, and DTI calculation. For DTI, Factor 7, the total monthly debt includes the calculated loan payment, Factor 3, payments on simultaneous loans, Factor 4, mortgage-related obligations, Factor 5, and other current debts, alimony, and child support, Factor 6. Total monthly income includes verified current or expected income plus income derived from verified assets.
Okay, that's ATR.
Okay.
Now, the qualified mortgage, or QM rule, this offers lenders a kind of safe harbor from ATR liability, right? What makes a loan a QM? What features can it have?
Precisely. The QM rule defines a specific category of loans qualified mortgages for which lenders are presumed to have complied with the ATR requirement. To be a QM, a loan must meet certain product feature requirements and specific underwriting standards.
Okay, let's start with the product features. What terms are forbidden in a QM loan? This seems crucial for the exam.
Absolutely crucial. A loan cannot be a qualified mortgage if it includes any of the following features. A loan term longer than 30 years.
Max, 30-year term.
Points and fees that exceed a specific threshold. Generally, it's 3% of the total loan amount, but that percentage threshold is actually tiered and can be higher for smaller loan amounts. But 3% is the general cap to remember.
Points and fees cap, generally 3%.
Negative amortization, where the principal balance can increase over time.
No negam.
Balloon payments, where a large lump sum is due at the end of the term. There are some very limited exceptions for small creditors in rural areas, but generally, no balloons.
Generally no balloons.
Or the ability for the borrower to defer repayment of principal, such as in an interest-only loan period.
No interest-only periods. Okay, those are the forbidden features. What about the underwriting requirements for a QM?
To originate a general QM, there are other temporary types, but focus on the general one. The creditor must underwrite based on specific criteria. The loan's APR cannot exceed the average prime offer rate, APR, for a comparable transaction by more than a specified margin. The general limit is 2.25% over APR for first liens, but this margin also varies based on loan amount and lien position.
APR cap relative to APR, generally 2.25%.
The creditor must verify the consumer's income and assets using reasonably reliable third-party records, just like under the general ATR rule.
Verifying income assets.
And the creditor must calculate the monthly payments using regular, substantially equal periodic payments that are fully amortizing and, critically, using the maximum interest rate that may apply during the first 5 years after the first payment is due.
Calculate payment using max rate in first 5 years.
There used to be a strict 43% DTI limit for general QMs, but that specific requirement was replaced by the APR-based limit I mentioned. However, DTI is still considered under the general ATR assessment, which underlies QM.
This presumption of compliance sounds powerful. You mentioned conclusive or rebuttable. What's the difference between those and why is it vital?
This distinction is absolutely vital for the exam. The Dodd-Frank Act created these presumptions of compliance for QMs.
Okay, conclusive first.
Conclusive presumption of compliance. This is the stronger protection. It is extended to qualified mortgages that are prime loans, meaning loans that are not considered higher priced or subprime, generally those with APRs below a certain threshold above APR. If a loan meets the QM criteria and is a prime loan, there's a conclusive presumption that the creditor made a reasonable, good faith ATR determination. It's very difficult for a borrower to challenge ATR compliance on these loans.
Strong protection for prime QMs. What about rebuttable?
Rebuttable presumption of compliance. This is extended to higher-priced mortgage loans, those that meet QM criteria but are considered higher-priced or subprime. APRs above the threshold but still within the QM limit. This rebuttable presumption lowers the burden of proof for subprime borrowers who believe that a creditor failed to make a reasonable good faith determination of their repayment ability.
So, still presumed compliant, but easier for the borrower to challenge.
Exactly. For higher-priced QMs, the lender is presumed to have met the ATR rule, but the borrower can overcome or rebut that presumption by presenting evidence showing their income and debts left them unable to meet the living expenses after making the mortgage payments. Understanding the difference conclusive for prime, rebuttable for higher-priced is absolutely key.
Conclusive versus rebuttable. Got it. Now, calculating those points and fees correctly is obviously essential for meeting the QM cap. What's included, what's excluded, and was there ever a way to fix mistakes?
Yes, correctly calculating points and fees is extremely important because hitting that 3% cap, or the applicable tier, is a hard requirement for QM status.
So what counts towards the cap?
Items included in the calculation are generally compensation paid directly or indirectly by a consumer or creditor to a loan originator, broker, or loan officer. Most items required to be included in the finance charge under Regulation Z. Certain real estate-related fees unless specific conditions are met, certain fees paid to affiliates of the creditor, and compensation paid to mortgage brokers, even if paid by the creditor.
Okay, LO comp, finance charges, some other fees. What's excluded?
Items generally excluded from the calculation are certain insurance premiums, like title insurance, credit insurance if not required, FHA upfront and annual mortgage insurance premiums, and VA funding fees. premiums for private mortgage insurance, PMI, that are payable after consummation, bona fide third-party charges not retained by the creditor, originator, or their affiliates, like appraisal fees, recording fees, if truly third-party, and, crucially, bona fide discount points.
Bona fide discount points are excluded. That's important. Now, what if a lender messed up the calculation? Was there a cure?
Yes, there was a cure provision, but it's important to note its specific applicability date. For qualified mortgages consummated on or before January 10th, 2021, if the creditor later discovered that the points and fees actually exceeded the applicable cap, the loan could still retain its QM status if certain conditions were met.
What were the conditions?
The loan had to meet the other QM product feature requirements. The creditor or its assignee had to pay the consumer the amount of the excess points and fees plus intrad. That payment had to be made within 210 days after consummation, and before the consumer filed a lawsuit, sent a written notice of the error, or became 60 days past due on the loan. And the creditor assignee had to maintain policies and procedures for post-consummation review and correction.
Okay, a 210-day cure window for older loans. What about now?
This is the critical point. That specific cure provision related to the points and fees cap is not applicable to loans consummated after January 10th, 2021. For loans originated after that date, exceeding the points and fees cap means the loan simply does not qualify as a QM under that specific definition. That date, January 10th, 2021, is a critical detail for your test regarding the QM cure provision.
No points fees cure after Jan 10, 2021. Very important. We've mentioned the CFPB constantly throughout this deep dive. It's clearly the major player now in consumer financial protection. Let's delve into its structure and mission formally.
Indeed. The Consumer Financial Protection Bureau, CFPB, is absolutely central. As we noted, it was established under Title X of the Dodd-Frank Act and officially opened its doors on July 21, 2011. Its primary role is being in charge of implementing and enforcing most provisions of federal lending laws related to protecting consumers in the mortgage market. It inherited authority for many consumer protection laws from 7 different federal agencies, consolidating that power.
Consolidating power. How independent is the CFPB within the government structure? Is it really separate?
It's designed to be very independent. Although Title X established it technically as an independent bureau located within the Federal Reserve System, Dodd-Frank put up strong walls to ensure its distinct separation and autonomy from the Federal Reserve Board.
Walls?
The law explicitly states that the Federal Reserve Board cannot intervene in any examination or any enforcement action before the CFPB director, appoint, remove, or direct any CFPB officer or employee, merge or consolidate any functions or responsibilities of the CFPB with any division, office, or banks of the Federal Reserve, or subject any rule or order of the CFPB to the review or approval of the Federal Reserve Board. So they really can't interfere with the CFPB's work.
Very strong independence. Who leads it?
It's led by a single director who is appointed by the president and must be confirmed by the Senate. The director serves a 5-year term. That 5-year term is a good detail to remember.
5-year term for the director. Got it. What are the core functions of the CFPB beyond just enforcing the laws it inherited? And which specific laws are explicitly under its protection?
Good question. In addition to enforcing the transferred laws, Dodd-Frank specifically tasks the CFPB with several core functions: conduct financial education, collect and respond to consumer complaints, research and monitor the markets for consumer financial products and services, supervise covered persons for compliance with federal consumer financial laws, and take enforcement actions for violations of federal consumer financial laws.
Education, complaints, research, supervision, enforcement. Broad mandate. Which laws specifically?
The CFPB has authority over federal consumer financial laws. Dodd-Frank specifically lists 14 enumerated consumer laws that fall under this umbrella. The list includes many we've discussed: FCRA, ECOA, HMDA, HOOPA, RESPA, TILA, the SAFE Act itself, the privacy provisions, Title V of GLB, and others like the Fair Debt Collection Practices Act, FDCPA, and the Homeowners Protection Act, HPA. Familiarity with the scope of laws under CFPB purview is helpful.
Okay, a wide range of key consumer laws. How does the CFPB actually conduct its oversight, its supervision, and examinations? And what are these UDAPs we hear about: unfair, deceptive, or abusive acts or practices?
The CFPB uses its supervision and examination manual to guide its process, based on 3 core principles. Focus on consumers, evaluating financial institutions based on the risks they pose to consumers. Data-driven examination, basing supervision activities on rigorous data analysis. Consistency, Applying standards and enforcing laws consistently across different types of institutions, both depository banks and non-depository, like mortgage companies.
Okay, consumer-focused data consistency. What about UDAPs?
During these examinations, examiners look for UDAPs, unfair, deceptive, or abusive acts or practices. Dodd-Frank gave the CFPB authority to prohibit UDAPs, even if they don't violate a specific enumerated law. Mastering these definitions is absolutely critical for the exam.
Okay, let's hear them. Deceptive.
An act or practice is deceptive if they are likely to mislead a consumer and the consumer's interpretation is reasonable under the circumstances. It's about the likelihood of misleading a reasonable person. An act or practice is unfair if injury to consumers is likely, not reasonably avoidable, and is not outweighed by potential benefits to consumers or competition. It involves a cost-benefit analysis focused on consumer harm.
And abusive. This one was new with Dodd-Frank, right?
Yes, abusive is the newest category and potentially the broadest. An act or practice is abusive if they interfere with a consumer's ability to understand the terms or conditions of a product or service, exploit a consumer's lack of understanding, or take advantage of a consumer's reasonable reliance on the mortgage professional to act in their interests.
Interferes with understanding, exploits lack of understanding, or takes advantage of reliance. Okay, those UDAP definitions are key. If a consumer does have an issue and wants to file a complaint, how do they engage with the CFPB, and what are the expected response times?
The CFPB has a dedicated consumer response unit to handle complaints. When a complaint is forwarded to a company, the company is generally asked to provide a response within 15 days. However, the CFPB expects a final substantive response, detailing the actions taken or reasons for not taking action, within 60 calendar days of receiving the complaint.
15 days for initial response, 60 calendar days for final response. Important timeframes. Beyond the CFPB, the Department of Housing and Urban Development, or HUD, also plays a significant role in housing. What's HUD's mission, and what regulatory authority does it still hold?
Right, HUD is still very important. Its mission is stated as to create strong, sustainable, inclusive communities and quality, affordable homes for all. While the CFPB took over enforcement of many federal mortgage laws, HUD retains sole responsibility for writing rules under the Fair Housing Act.
Fair Housing Act is still HUD's domain.
Yes, although enforcement might be coordinated with the CFPB or DOJ. HUD's Office of Fair Housing and Equal Opportunity, FHEO, is the primary enforcer of the Fair Housing Act within HUD. HUD also continues to oversee important agencies like the Federal Housing Administration, FHA, which insures mortgages, and the Government National Mortgage Association, Ginnie Mae, which guarantees mortgage-backed securities containing government-insured or guaranteed loans.
Okay, FHA and Ginnie Mae oversight too. What are some key programs or services HUD provides that are particularly relevant for us as loan officers to know for the exam?
There are two main areas highly relevant for the SAFE exam.
What are they?
First, FHA loan programs. While you need detailed knowledge for originating FHA loans for the SAFE exam, know that the FHA, operating under HUD, provides mortgage insurance to FHA-approved lenders, protecting them against losses if a borrower defaults. Key programs include the Standard Single-Family Insurance Program, Section 203B, the Rehab Loan Insurance, Section 203K, and FHA's Reverse Mortgage Program, the Home Equity Conversion Mortgage, HECM.
FHA programs under HUD. Got it. Second area.
Second, and highly important regarding compliance points we've discussed, homeownership counseling. HUD plays a central role here.
Counseling. How so?
Remember the RESA-PAY requirement. We discussed that RESA-PAY requires lenders to provide loan applicants with a list of homeownership counseling organizations. This list must be given no later than 3 business days after receiving a completed application.
Right, the counseling list disclosure.
And the requirements for that list are specific. It must be clear and conspicuous, in writing, provide agencies local to the consumer, based on zip code or county. The list itself cannot be more than 30 days old when provided, and it must include at least 10 HUD-approved counseling agencies.
3 days, written, local, current, 30 days, 10 agencies. Got it. Is there specific language?
Yes, the regulation provides model language, and lenders are considered compliant if they use wording like this. The counseling agencies on this list are approved by the U.S. Department of Housing and Urban Development, HUD, and they can offer independent advice about whether a particular set of mortgage loan terms is a good fit, often at little or no cost. You can find other approved agencies at the Consumer Financial Protection Bureau's CFPB website or by calling. You can also access a list of nationwide HUD-approved counseling intermediaries at. You should recognize the essence of that disclosure.
Okay, recognize the counseling list disclosure language. Is counseling ever mandatory?
Yes, and this is crucial for the exam. Homeownership counseling from a HUD-approved counselor is mandatory in specific scenarios. For high-cost home loans under HOPA, Dodd-Frank CFPB rules require borrowers receive counseling before they can accept a high-cost loan.
HOEPA loans require counseling.
For loans that permit negative amortization, first-time borrowers considering a loan with potential negative amortization must complete counseling before accepting the loan.
Neg-Am loans for first-time buyers require counseling.
And for all borrowers seeking an FHA HECM reverse mortgage, counseling is a prerequisite for obtaining an FHA-insured reverse mortgage.
HECMs require counseling. Okay, mandatory counseling for HEPA, Neg-Am first-time buyers, and HECMs. That's very important. Wow. Okay, we have just navigated a labyrinth of critical regulations. Everything from fair credit reporting with FCRA and FACTA, protecting data with GLV and red flags, ethical advertising under MP, electronic signatures with e-sign, D&C rules, combating financial crime with Patriot and BSA, all the way through the massive Dodd-Frank Act and its children like ATR-QM, HEPA changes, and finally the roles of the CFPB and HUD, especially regarding counseling.
It's a lot, but hopefully breaking it down like this helps. This deep dive, really, it's aimed to arm you with those precise definitions, the key time frames like the 30 days, 24 months, 3 years, 5 years, 7 years, 10 years, all those numbers and the nuanced distinctions you absolutely need to tackle the SAFE exam with confidence.
Yeah, those specific numbers and distinctions seem critical for that perfect score.
They really are. Remember, success on the SAFE exam isn't just about, rote memorization. It's about understanding the connections between these rules, why they exist usually to protect consumers or the financial system. By focusing on the exact language from the source material, the specific numerical details we highlighted, you're not just prepping for a test. You're building a really solid, robust foundation for your career in mortgage lending. These details, they're what will distinguish your understanding.
You've just equipped yourself with a ton of knowledge,
Yeah.
a real arsenal. Now, as you go out and prepare to apply this information, maybe consider this. How will truly understanding the why behind these complex regulations, not just the what, empower you to better serve your clients, navigate the gray areas, and handle the real-world scenarios you'll face? Thinking beyond just passing the test. That's where true mastery begins. Now, go get that perfect score.